Welcome to the Deep Dive, where we streamline a monumental stack of research into the exact insights you need to be well-informed and fast. Today, we are taking a deep dive into the world of cloud security, specifically looking at CrowdStrike Holdings, Inc. That's ticker CRWD. Our mission here is to really get into their recent Q3 fiscal year 2026 earnings report. It just dropped on December 2nd. We're going to go beyond the headlines and analyze their competitive advantages, their financial health, and the big one, the debate around their valuation.
And just before we unpack all of that, we have to start with a required reminder. This discussion is purely for informational and educational purposes. We are synthesizing public data, but this is absolutely not financial advice. So we really urge you, the listener, to do your own rigorous due diligence.
Absolutely, a very important point. Okay, so let's set the stage because the market context here is key. CrowdStrike just closed at $512.03, and the stock has just surged. I mean, nearly 25% in the past quarter alone. That kind of momentum, it really brings up a fundamental question. Is the market just pricing in perfection at this point? And where does that premium even come from?
Well, to understand the premium, you have to start with the business itself. I mean, CrowdStrike isn't just selling some antivirus software. They provide this cloud-delivered protection that covers really four big pillars: endpoints, cloud workloads, identity, and data. And it's all delivered through one subscription platform called Falcon.
And that brings us right to what analysts call the CrowdStrike Moat. It's this idea of a single unified platform, one sensor, one console, one data backend. They talk about it all the time. But for an actual customer, why is that so powerful? Why does that create a competitive barrier?
It solves a huge pain point. Think about legacy security. IT teams were managing, 5, 8, maybe 10 different security tools?
Right, a total mess.
Exactly. Each one needed its own agent, its own console, its own expert, basically. CrowdStrike just collapses all of that complexity, and that creates immense stickiness. Once a customer has integrated, say, their EDR and their identity protection on the Falcon platform, well, leaving means ripping out the core of your security operations. The disruption is just. It's prohibitively costly. It creates these incredibly high switching costs.
So it's not just about better security. It's also a powerful financial reason for customers to just stay put. And the numbers seem to back that up.
They do.
The sources we looked at noted that nearly half of all their customers now use 6 or more modules. I mean, that's not a trial run. That's deep entrenchment.
That is the definition of platform adoption at scale. And the engine driving this is their Falcon Flex subscription model.
Okay, tell me about that.
It simplifies things. A customer can start small and then just bolt on new capabilities as they need them.
Yep.
And we saw that in the results. The annual recurring revenue, or ARR, from those Flex accounts, it surged over 200% year over year. It's now over $1.35 billion. So Flex is really the engine driving that growth.
Okay, so let's talk about the future of that platform then. AI. Cybersecurity feels like the most critical place for AI, both for the good guys and the bad guys. CrowdStrike says AI is their biggest opportunity. How are they actually using it to widen that moat we just talked about?
Well, they see that as AI transformation speeds up, the attack surface just gets bigger and bigger, so demand goes up. Their advantage is the sheer volume of threat data they collect. All of that data feeds their models, and that creates this powerful network effect. More customers means better AI.
Right.
And they introduced something called Charlotte AI, which they call an agentic SOC orchestrator.
Okay, agentic SOC orchestrator.
Yep.
Sounds like marketing speak. What does that actually do?
It's not just marketing. Agentic means the AI can perform tasks on its own. It takes the insights from all that threat data and then proactively automates threat hunting. So for a security analyst, it dramatically cuts down the time to fix a problem. Their job shifts from manually chasing alerts to supervising an intelligent partner.
That's a huge shift in the workflow. Okay, so we've got the foundation, the unified platform, the AI engine. How did that all translate to the Q3 earnings report?
The summary is just robust execution. They had a really strong Q3, and they beat expectations on every single guided metric. Total revenue hit $1.23 billion.
But for a subscription company, everyone is watching ARR. What did that tell us about their momentum?
That was the big story. They delivered a record Q3 net new ARR of $265 million.
A record.
Yeah. And to put that in perspective, that's 73% year-over-year growth. It beat their own guidance by over 10%. And their total ending ARR, it accelerated to $4.92 billion.
So they're getting bigger and growing faster.
At the same time, which at this scale is really impressive. It signals real market dominance.
And beyond just the top-line growth, what about profitability? Because that's what's going to justify that premium valuation we mentioned.
Absolutely. The subscription gross margin was an incredible 81%.
81%.
You just don't see that outside of pure software. And on the non-GAAP side, they had a record Q3 free cash flow of $295.9 million. That's a 24% margin.
So this isn't growth at all costs. This is efficient growth.
It's growth with efficiency and increasing leverage, yes.
So if the numbers are that good, who are they taking these customers from? Are they going after the big established players?
They are, and this is where you can see the strategy working. They're actively disrupting competitors across the board. They're winning against legacy SIEMs, tools like Splunk. They're also beating specialized cloud vendors like Wiz, and crucially, they're taking a lot of market share from Microsoft Defender for endpoint.
Wow, so they're fighting on multiple fronts at the same time and winning.
They are, and the partnership with Kroll really proves this out. Kroll is a massive global risk advisory firm. They're migrating nearly 500,000 endpoints to the Falcon platform. When a big, objective third party like that makes a move, it basically validates your position as the new security backbone.
Okay, so Q3 was a huge success. How's management feeling about the future? Did they raise their guidance for the full year?
They raised it across the board, which signals a lot of confidence. The full-year earnings per share forecast is now projected to be in the range of $3.70 to $3.72.
Which is a pretty strong indicator for future profitability.
A very strong indicator. And they're already talking about the longer-term horizon.
What about fiscal year 27?
The company is confirming they expect year-over-year net new AR growth of at least 20% for FY27. They are very explicitly trying to become the operating system for cybersecurity in this new AI era.
That's a big ambition. And it relies completely on them continuing to innovate. We saw some details about new acquisitions, Onum and Pangea. How do they fit in?
They fill some important gaps. Onum is all about strengthening their data pipeline so they can process all that data flowing in even faster. Pangea is focused on AI infrastructure protection, which is, it's vital as companies deploy their own AI models.
And what about their existing products?
They're expanding their Falcon Next-Gen SIEM. A huge move there is a new partnership with AWS.
Oh, that's interesting.
Yeah, it makes their SIEM natively available right inside the AWS Security Hub console. It's a direct shot at Splunk, making it way easier for AWS customers to switch.
So the strategy is sound, execution is strong, numbers are great. But this all brings us back to the big problem for any investor looking at this stock, the valuation.
This is it. This is the reality check.
And this is where the real tension for you, the learner, comes in.
Exactly. The company's performing almost perfectly, but all the market commentary points to a stretched valuation. The stock price is already priced in so much good news.
So any small mistake could cause a big drop.
A very sharp correction, yes.
Let's put some hard numbers on that. The consensus analyst price target is a pretty bullish $544.60. But the published fair value estimate is actually $488.51.
Which is below where the stock is trading right now.
Right. It means the market is currently paying a premium of over $20 a share above what analysts think the company is worth based on its current financials.
And to really understand how high that is, just look at their price to free cash flow on a trailing 12-month basis. It's 110.4.
110. And for a normal high-growth software company, you might see, what, 50, 60?
Maybe. Paying 110 means the market isn't just hoping for a good future, it's demanding a perfect one for years to come.
And even in this amazing non-GAAP quarter, there was some financial friction, wasn't there? What about the GAAP numbers?
Right. Despite that record non-GAAP profitability, they did have a GAAP net loss of $34 million. Management said it was mostly due to costs from that July 19th incident.
It's a small wrinkle, but in a perfection story, any wrinkle stands out.
It does. And that incident is still affecting their cash flow. They expect about $33 million in related cash payments to hit their Q4 free cash flow.
So even with a flawless platform, these minor non-operational things can still have a real financial cost.
They can. It just slightly mutes those efficiency metrics in the short term.
So the tension for an investor is crystal clear. The bull case is all about the need for cybersecurity, the crazy ARR growth, the AI dominance.
And the bear case is that the valuation, that PFCF of 110, already reflects all of that. There's just no margin for error.
Flawless performance is the baseline, not a bonus at this price.
Not at this altitude, no. But let's bring this all together with a final thought, specifically about that valuation problem. CrowdStrike is displacing Microsoft. They are winning against Splunk. They are disrupting entire markets. So given the immense value customers get from consolidating everything onto one platform, simpler buying, fewer vendors, better security, does that change how we should calculate fair value?
That's a great question.
Is it possible that a company that is becoming the indispensable operating system for cybersecurity simply demands a new valuation model, one that can tolerate this kind of premium?
That is a phenomenal thought to chew on. We started by asking if there's any room left for the stock to run. And I guess the answer is, it depends entirely on whether you believe that this unified platform thesis justifies a whole new way of looking at value. The platform is powerful, execution is strong, but the market is demanding absolute perfection. And that wraps up our deep dive into CrowdStrike. Thank you so much for joining us and letting us guide you through all this information. If you found this deep dive valuable and you want to keep getting informed quickly and thoroughly, please take a moment right now to subscribe to the channel and hit that notification bell. Your support really does ensure we can keep delivering these essential deep dives right to you. Until the next deep dive, stay curious.